So this is a very important concept to understand, that the different performance obligations should be identified within a contract. A contract may have many obligations in it, and those obligations should be identified. Now, there is a concept of distinct goods and services. Now, distinct means obviously they are different from each other. You can make a distinction. Okay, car is a different thing. The service of a car is a different thing. The warranty is a different thing. When you buy a phone is a different thing. Service is a different thing. And then the internet or the portable Wi-Fi device is a different thing. You can make a distinction between these things. So distinct goods and services. At the inception of the contract, the supplier must identify each promise. Now, each promise means there will be multiple performance obligations to transfer distinct goods and services. Distinct means that they are different from each other, and these are the different performance obligations. A good or service is distinct if both of the following criteria are met. Now, in order to classify the goods or services as distinct, the following criteria should be met. This is very important. I have given the explanation of these 2 points on the next slides, but first of all, you need to understand these points. The customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. The customer can benefit from the good or service either on its own, like by themselves, or together with other sources that are readily available to the customer. They have already those resources. So they can take the benefit either themselves or with or in conjunction with the other benefits they already have. The supplier's promise to transfer the good or service is separately identifiable from the other promises in the contract. Now, one promise should be distinct from the other. Is it identifiable? If you see this contract, can you identify the 3 different promises? A car is a different promise, 3-year service is a different promise, warranty is a different promise. So obviously by providing only the car, they cannot fulfill their 3-year service promise. By providing only a 3-year service, they cannot fulfill their warranty promise. These are the separate promises. So if the promises can be identified separately and the customer can benefit from the goods or service on its own, then we're going to say these goods and services are distinct from each other, and these are separate performance obligations. We'll do the example, and then you will be able to identify and grab the concept quickly. So example, construction contract. Goods and services are not distinct. Okay, this is a building contractor enters into a contract to build a new office block for a customer. The vendor is responsible for the entire project, including procuring the construction materials, project management, and associated services. The project involves site clearance, foundations, construction, piping and wiring, equipment, installation, and finishing. So you see there are so many things. Again, read it again. A building contractor enters into a contract to build a new office block. The vendor means the contractor is responsible for the entire project, completing it, including procuring the construction material, buying the construction materials, project management, and associated services. And it involves clearance, foundation, construction, piping, wiring, everything. Although the goods or services to be supplied are capable of being distinct. Like, for example, clearance. The clearance is a different thing. Foundation is a different thing. Construction is a different thing. Piping and wiring. Usually we have different vendors for it. Like there are people who are just doing the site clearance. There are people who are just doing the foundations. There are companies who are just doing the construction, the piping and wiring. There are separate companies, separate vendors for that. So by nature, you can say that these are distinct. Although the goods and services to be supplied are capable of being distinct, okay, because the customer could, for example, benefit from them on their own by using, consume or selling the goods, and could purchase them from other suppliers. Yes, because we have the different vendors available in the market. They are not distinct in the context of the vendor's contract with his customer, because it was written that they will be building an office block. So you see what is the output, what the output they have to give, office block. This is their ultimate contract. They have to build an office block for the customer. And what are the inputs? In the inputs, there are many activities, which includes clearance, foundation, construction, piping, blah, blah, blah. All these inputs will make an office block. So what is the ultimate contract? To build an office block. Can we just do the clearance and get aside? No. Can we just do the foundation and get aside? No. Because ultimately what we have to do is to build them an office block. So these are not distinct in the context of the vendor contract. This is because vendor provides a significant service of integrating all inputs into a combined output. So these are not the different performance obligation. This is going to be treated as a single contract. Now we have another example. Example software scenario A. Now again, this will more clear your concept. Very good example. You'll not find in the book. A vendor enters into a contract with a customer to supply a license for a standard off-the-shelf software package. All right. You need to be aware of these scenarios because the exam question is going to be the same. The exam question will involve the same scenarios. So make yourself habitual of reading these case studies and understanding what they are saying. Because in the exam you will be having full case studies and there will be parts like these examples. So a vendor enters into a contract with the supplier, with the customer to supply a license for a standard off-the-shelf software. So they need to provide them the software license. Install the software. They have to give them the license. They have to install the software and to provide unspecified software updates and technical support for the period of 2 years. You know, when we use the software, sometimes there are bugs that you have to do the updates. You have to provide them the technical support. The vendor sells the license and technical support separately. Like there are customers to whom they only sell the license. There are customers to whom they only give the technical assistance. And the installation service is routinely provided by a number of other unrelated vendors. Now, usually this installation is done by some other people. This is not routine part of the contract. The software will remain functional without the software updates and technical support. That means if we only give them the software, they can install it by someone else because there are people who can install it for them. And it can work without the software updates and technical support. That means the customer can use it by their own. Remember the point? Let's go back and see. The customer can benefit from the good or service on its own or together with other resources they already have, they readily have. So in this example, the software will remain functional without the software update. That means they can use it even without the updates. So if we only provide them the software and the license, they can make it install from someone else because the people are over there to provide the installation services. They can use it without the software updates and technical support. That means they can benefit from their own. The software is delivered separately from the other goods and services. can be installed by a different third party. This is the explanation which I'm giving you, which is making a base for your answer. Okay, and remains functional without the software updates and technical support. Therefore, it is concluded that the customer can benefit from each of the goods and services on their own. In addition, each of the promises to transfer goods or services separately identifiable, because it is quite well written in the question that the license and the technical support is a different thing. So what are the performance obligation? Software license is a different performance obligations. Installation service is a different performance obligation. Software updates is a different performance obligation. Technical support is a different performance obligations. So these are distinct from each other. Okay, now software scenario B, again very important thing, with a little bit modification in the same scenario. The vendor's contract with its customers is the same as in the scenario A, the previous one which we just read. Expect that the part of the installation service, the software is to be substantially customized in order to add significantly new functionality to enable the software to interface with other software already being used by the customer. Now we cannot provide them the software only. Once we provide them the software, we have to make that thing customized for the customer. Otherwise, they cannot benefit from that thing. It is clearly written over here. Except that as part of the installation survey, the software is to be substantially customized. That means we have to make it for them in order to add new functionality and to enable the software to interface that obviously they cannot benefit, they cannot use it if it is not customized. The customized installation service can be provided by a number of unrelated vendors. In this case, now this is the explanation. In this case, although the installation service would be provided by other entities, there are people who are providing that. The analysis required by IFRS 15 indicates that within the context of its contract with the customer, the promise to transfer the license is not separately identifiable because the customer cannot benefit from the software only. You have to make it customized for them. Even the people can make it customized, but they cannot benefit, which is the wording used by the standards. So this means in this scenario, software license and customized installation service is a single performance obligation. Although software updates and the technical support remains the distinct goods and service. In the previous scenario number A, because the customer can benefit just from the software, that is why the software license and installation service was a distinct goods or service. Now here, because they cannot benefit from the software themselves, so here the software license and the customized installation service is a single performance obligation. So this is a single performance obligation. And these are the distinct. Example number C, software scenario C. The vendor contract with its customer is the same as in the scenario B, except that vendor is the only supplier that is capable of carrying out the customized installation service. The software updates and technical support are essential to ensure that the software continues to operate satisfactorily. And the customer employees continue to be able to operate the IT related systems. No other entry is capable of providing the software updates and the technical support. So in this C part, C example, you are providing them the software. No one can do the installation. No other party can do the installation. The software updates and technical is essential for running the software. Otherwise, the software cannot be run. That means the customer cannot benefit from that. In this case, the analysis IFRS 15 require indicate that in this contract, in the context of its contract with the customer, the promise is to transfer a combined service. This combined service is a single distinct goods and service. Now, in the example A, there were 4 distinct goods and services. In the example number B, there were 3. In the example number C, because you are the only one who can install the software, the updates and technical support is essential for running the software in order to use it. That is why it is going to be a single performance obligation. So license, updates, technical support, installation, this is a one contract, a single contract. All right, now you have the step number 3. We are done with the contract, identifying the contract. We are done with the identification of different performance obligations. Now we have the step number 3, which is determining the transaction price. And I told you at the start of the lecture that when we are talking about the transaction price, it has many components in it. It has many components in it. I told you that we have the fixed consideration, the consideration which is clearly mentioned in the contract. We may have the variable consideration. That means it varies and it changes. We have the non-cash considerations. We have the financing element. We have the consideration payable to a customer. So yes, these can be as part of the contract. So you may have the fixed consideration, you may have the variable consideration, the non-cash consideration, financing element, consideration payable to the customer. So we'll be discussing these things one by one. Now, first of all, you have the variable consideration. Now, the variable consideration, as I gave you the example, that for example, you may enter into the contract where you are specifying that, okay, if you are buying this number of goods, then the price will be this. If you are buying this number of goods, the price will be that. So you are having the different considerations. So variable consideration. Instead of the amount of the consideration specified, that means fixed, the amount receivable by the vendor may be variable. That means it changes accordingly. In other cases, the consideration may be a combination of fixed and variable amounts. Yes, it can have the fixed element. Okay, you have to pay this much amount, and the rest is dependent. Like for example, like you buy the internet from the internet company, the telecommunication company. They say, okay, you are paying this much amount. For example, you are paying 3,000 rupees, and in this 3,000 rupees, you are getting the 100 GB data. But if you exceed it, if you exceed by the 100, then you have to pay this much amount for the next 10 GBs, this much amount for the next 10 GBs, and this much amount for this. Similarly, you go to the courier service and you are sending someone, like sending something to the your friend or something like that. For example, you're sending fruits of your garden to someone, for example. uh, most of the examples are going to be related with the food. So anyways, it's all about interest. You go to send someone the fruits, and the courier company usually have the fixed rate. Okay, whatever weight you are sending, you have to pay this much amount. Whatever in terms of weight you are sending, this is the fixed amount you have to pay. But if this amount exceeds, then you have to pay this much amount per kg. Now that means it has the both components of the fixed and variable amounts. Now variable consideration can arise for a wide range of reasons, including discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, penalties, or other similar items. The principle is that if there is any potential variation in the amount that a vendor will receive in return of its performance, then the related provision in IFRS 15 will apply. Like you are specifying, for example, that okay, if you are buying this much amount from us, we'll be giving you this much discount. Now that means some consideration is fixed and other is the variable. So you have to incorporate those variable consideration into your contract. Now let's see the example. Okay, first of all, there are two things you need to understand. The transaction price is not adjusted for the effects of the customer credit risk. We have already discussed this thing that from the very start, if you are unsure regarding the receipt of the revenue, then you cannot record it as the contract. We are not talking about the bad debts over here. Variable consideration is not covering the bad debts. If the contract includes variable consideration, then an entity must estimate amount it will be entitled to. Like say, for example, you're giving customer a rate list. Okay, if you're buying 100 units, price is this. If you're buying 200 units, now obviously they are going to decide it later how many units they will be buying. But what price you will be using? What price you will be using right now? So you have to estimate it. IFRS 15 says that this estimate can only be included in the transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue will not occur when the uncertainty is resolved. This is a very important thing you need to understand. So simply IFRS 15 says that you are going to record an amount which you think is going to be received, and you are not going to have a reversal entry for this. That means it is probable, it is highly probable that you will be receiving that amount which you are estimating. And if you have any doubts regarding that, if you think that now you are recording the revenue, but in future you have to make a reversal entry, then you cannot record that variable consideration from the very start. So this is clearly written by the IFRS 15 regarding the variable consideration, that you have to estimate it, but your estimate should be reasonable. Your estimate should be based on the probabilities. Your estimate should not involve the things which you are going to reverse later on. If that is the case, then you cannot make part that thing uh, in the variable consideration. Now, two possible methods of estimate the variable consideration, because we are saying when it comes to the variable consideration you have to estimate it. So there are two methods. There are two possible methods which can be used, which are required to be applied consistently throughout the term of each contract. The first one is expected value method. The second one is most likely amount. Now, sometimes you have multiple options. Like maybe they buy 100 units, maybe they buy 200 units, maybe they buy 300 units. In that case, the sum of probability weighted amounts should be taken. The most likely amount means like, okay, they are going for this much amount. Okay, you can do an example and then you will get it. The first example is for expected value method. On 1st January 20x4, a vendor entered into a contract with the customer to build an item of specialized equipment for delivery on 31st March 20x4. The amount of the consideration specified in the contract is CU2 million, or you can say $2 million. But that amount will be increased or decreased by CU10,000 or $10,000 for each day that the actual delivery date is either before or after 31st March 20x4. Now you are making a specialized equipment for a customer and you have to deliver them that thing on 31st March 20x4. The price of the contract is $2 million. But it can be increased or decreased by 10,000, that means plus minus 10,000 for each day if the delivery date changes. Now, what are you going to do regarding this? In determining the transaction price, the vendor considers the approach that will better predict the amount of the consideration that it will ultimately be entitled to, and determines that the expected value method is the appropriate approach. This is because there is a range of possible outcomes. Here in this case, we'll be using the because maybe we deliver them on 1st April, maybe we deliver them on 2nd April, maybe we deliver them on 30th March, on 29th March. So that means there are multiple outcomes. So if this is the case, we are going to apply the expected value method. Now the most likely amount. This is the second example. A vendor enters into a contract with the customer to construct a building for CU 1 million. So $1 million. The terms of the contract include a penalty of $100,000 if the building has not been completed by a specified date. Now here, there are only two possibilities, not multiple possibilities. There are only two possibilities. The two possibilities are either you will be completing the building on the required date or you will not be doing that. If you think that you will be able to complete the building by the required date, then there's no penalty. If you think you will get late, then there's no per day penalty. Even if you get 1 day late, you have to pay the $100,000. So there are only two possibilities. In the previous examples, it was each day thing, 10,000 each day plus minus. So there were multiple possibilities in the previous example, but here there are only two possibilities. The first possibility is you can avoid the penalty by completing it on time, or you have to pay the penalty. So here we're going to use the most likely amount. Either you're going to avoid the penalty or you are paying it. In determining the transaction price, the vendor considered the approach that will better predict the amount. This is because there are only two possible outcomes over here. So the estimated amount of variable consideration is updated at each reporting date to reflect the position at that date. So this was to make sure that which method you will be using in what circumstances. So either you will be using the expected value method or you will be using the most likely amount. Now you have another example. All right, on 1st December 20x1, Bristow provides the service to a customer for the next 12 months. The consideration is 12 million. Bristow is entitled to an extra 3 million if after 12 months the number of mistakes made falls below a certain threshold. The basic amount they will be getting is a 12 million, which is the fixed amount. The 3 million is the variable amount, and that is based on a benchmark, on a criteria that if a number of mistakes falls below a certain threshold, a certain benchmark. Now 12 million is fixed and 3 million is variable. Required. What is the requirement? Discuss the accounting treatment. Okay, for if Bristow has experience of providing identical service in the past, and it is highly probable that the number of mistakes made will fall below the acceptable threshold. They know that they can do it. They know they will be able to make their mistakes below than the certain threshold. The second option is Bristow has no experience of providing this service and is unsure if the number of mistakes will fall below the threshold. Now again, you have two methods, expected value method and most likely amount method. So first of all, it is written that 12 million is the fixed consideration, the 3 million component is variable. Now, Bristow expects to hit the target in the A part, this is A part, using the most likely amount because they have the past experience and they can do it. So Bristow must decide whether to include the estimate of variable consideration in the transaction price. Based on past experience, it is highly probable that a significant reversal will not occur. That means they know that they are recording the revenue and they are not going to reverse it later because they will make it. So what revenue they should record? 15 million. But now they are providing the service over the time, then they have to do the apportionment accordingly. So because of the dates. On 1st December, they enter into contract and their year end is 31st December, so there is only 1 month. So they're gonna prorata it. The second one is depending on the estimated likelihood of hitting the target, the variable consideration would be estimated either 0 or 3 because they have no data whether they will be able to make it or not. So they should not record the 3 million because they are not sure about anything. They should only record 12 million and the pro rata 1 million. So here they should record 1.25 billion and over here they should record 1 million.